Hello everyone, welcome to Chapter 34. This is going to be a really important chapter because I'm going to be diving deep into the concept of liquidity. In this chapter, I'm going to break down exactly what liquidity is, how it works, and most importantly, how you can exploit it by understanding the details and intricacies behind it. I'll also go through the types of liquidity, how it influences price action, and how you can use the concept of liquidity to your advantage. By understanding it, you can potentially exploit price movements and expansions in the markets and derive energy from it in your trading. So let's jump into the chapter. Alright, first up, let's discuss what liquidity is and why it's important. Let's start with the basic idea. In my opinion, when it comes to the ICT concept, the way liquidity can be defined is that liquidity is the fuel that drives price action. That's the simplest and most powerful way to understand liquidity. Basically, liquidity is what moves price. Market makers, whether people or algorithms, are always targeting key levels in the market where institutional and retail orders are stacked in the form of liquidity. That's the definition. Another way to think of liquidity is that it represents the collection of all orders in the markets, and wherever there's a cluster of buy or sell orders, that's where liquidity lives. Price will naturally gravitate towards those areas because that's where the most volume can be filled. The main takeaway here is this: liquidity is the driving force behind the market. It's a collection of other market participants' orders, and the market maker's job is to take out that liquidity in the form of hunting stop losses, filling positions, and creating opportunities. Everything that price does, every expansion, every reversal, every manipulation, it's all driven by liquidity. Now that we've talked about what liquidity is, let's move on to why it is important and why you really need to understand its significance in order to become profitable. First of all, understanding liquidity helps you avoid getting trapped by retail manipulation. The way the market is designed, it sets traps. It builds up liquidity and lures in retail traders, and once it does that, it reverses on those positions and manipulates price action to clear those levels and take out liquidity. If you understand how liquidity works, you'll be able to see those traps forming ahead of time and avoid getting caught on the wrong side of the market. Second, it allows you to anticipate and predict price movements more accurately. When you know where liquidity is, you know where price wants to go next. You're not just reacting, you're planning ahead because you know where liquidity is lying. Price always seeks liquidity before making its real move. If you understand where that liquidity lies, you can position yourself before the expansion begins and capitalize on it. Third, liquidity gives you the closest insight into what the market makers are actually trying to do. Obviously, we can never know their intentions with 100% certainty, but out of all the concepts out there, liquidity gets you the closest to understanding and aligning yourself with what they are likely aiming for. Lastly, liquidity is at the core of all high-probability trade setups. The best setups, the cleanest reversals, the strongest continuations, they all revolve around the concept of liquidity and non-liquidity. Liquidity is not just important, it's essential if you want to become profitable and if you want to accurately anticipate and predict strong expansions or directional moves. Alright, now that we've understood what liquidity is and why it's so important, let's talk about how it actually works and how you can exploit it in your trading. Now here's the deal, price only moves for three reasons. It either moves to generate liquidity, to purge liquidity, or to fill liquidity. That's it. Every single move you see on the charts falls under one of those three categories or objectives. Price is either creating liquidity by forming equal highs, equal lows, low resistance liquidity runs, or failure swings. It does all of these things to generate liquidity. Or it moves to hunt that liquidity by forming manipulation profiles above or below swing highs and swing lows, or equal highs and equal lows. Alternatively, price moves to fill liquidity in the form of rebalancing inefficiencies or filling gaps, such as filling order blocks, fair value gaps, and opening gaps. Apart from that, everything else you see is just noise. But the important thing to understand is that every single move you see on the chart falls into one of these three categories. Now, understanding how price moves in relation to liquidity gives us an edge. Not just a small edge, but a significant one. Once you understand that liquidity is what fuels price, and you believe that liquidity is the driving force behind the market, you can begin to strategically position yourself ahead of time. Instead of reacting to price, you are anticipating where liquidity lies and planning your trades based on where price is likely headed next. This is where liquidity becomes super practical. It helps you clearly identify two things: reversal moves or continuation moves. You'll start to spot whether price is just purging liquidity for a reversal, or if it's building up liquidity for a strong continuation move. By learning to differentiate between the two through the understanding of liquidity, you'll be able to filter out bad trades and take high-probability setups with more confidence. So to sum this part up, by learning how liquidity works and seeing how price interacts with it, you put yourself in a much better position to read the market, avoid traps, and trade in sync with the bigger picture. Now let me break down the concept of liquidity with this graphic. First of all, let's discuss this price action on the left. You can see with this price action, price formed these equal highs and created these failure swings, where price wasn't able to take out the initial high. It formed this low-resistant liquidity, and it did that for one purpose: to generate liquidity above these highs. It generated low-resistant liquidity. In the second price action, you can see that after it generated liquidity, the only move that made sense was to take out this low-resistant liquidity and have a low-resistant liquidity run. Price expanded above, had this manipulation profile, and with this particular move, it took out the liquidity. From there, it reversed lower. In the third price action, you can see that after the reversal, it then formed, let's suppose, a fair value gap here, or maybe a breaker block as well. From here, you can see price retraced back higher, filling the liquidity by maybe testing the fair value gap or testing this breaker block right here. Then it expanded lower. The reason it had this retracement move higher was to fill liquidity. You can see that based on liquidity, you can basically categorize all of these moves into either one of those three categories. Price only moves to either fill liquidity, purge liquidity, or generate liquidity. Okay, so now in this slide, let's talk about the types of liquidity, what they are, how they work, and how understanding them can help us make better trading decisions, refine our analysis, and improve our ability to anticipate and predict price moves more accurately. At its core, liquidity can be broken down into two main types: external range liquidity, ERL, and internal range liquidity, IRL. Each one has its own characteristics, and price reacts to them differently. The first one, external range liquidity, or ERL, refers to the highs and lows, or swing points, on the chart. These are the obvious areas where stop losses from both retail and institutional participants tend to sit. Naturally, these areas become liquidity pools that price is drawn to. On the other hand, internal range liquidity, or IRL, refers to the gaps and blocks within a price range. These could be fair value gaps, opening gaps, or blocks such as order blocks, breaker blocks, rejection blocks, propulsion blocks, and so on. These internal range liquidity areas act as internal inefficiencies or zones that price often comes back to test, fill, or mitigate before moving toward external range liquidity or making its larger directional move. In some unique cases, IRL or ERL can represent highs or lows too. For example, let's say price is rejecting below a low in a bullish order flow, or rejecting above a high in a bearish order flow. In those kinds of cases, internal range liquidity could be in the form of highs or lows as well. But generally speaking, ERL refers strictly to highs and lows, while IRL typically refers to blocks and gaps. I'll explain the visuals later when we go over the charting examples. For now, understand that the real power comes from understanding how these two types of liquidity interact with each other. That's where market structure and flow really come together. Here's how it works. Price doesn't just randomly move from one high to another or from one block to another. External range liquidity and internal range liquidity move in tandem. They follow a sequence, and understanding that sequence gives you a real edge. Whenever price takes out an external range liquidity, say a high or a low, the next thing it usually does is move into an internal range liquidity or inefficiency. That might mean coming down to test a block, fill a gap, or react to some internal inefficiency. Once that internal liquidity is filled, price then starts moving toward the next ERL, either a new high or a new low, and begins its next directional move. You can think of it like a rhythm or a cycle, from ERL to IRL, then ERL to IRL again. Price flows from external to internal and back to external. This relationship is crucial because once you understand it, you'll know exactly what to expect when certain things happen. For example, if price just took out a high, an ERL, you don't assume it will immediately take out another high. Instead, you look for an internal range liquidity fill, maybe a fair value gap or an order block test. Once that's done, then you can look for the next external range liquidity target. This gives you a much more accurate roadmap of how price is likely to move. It also keeps you from chasing trades or expecting immediate follow-through when you know that price needs to go through this rhythm, from external range liquidity to internal, and then back to external. In summary, understanding the interaction between external range liquidity and internal range liquidity allows you to read market flow more accurately. It helps you anticipate the next likely move with more confidence, and it keeps you from getting confused when price doesn't immediately follow through after a liquidity sweep. This is one of those concepts that really ties everything together and gives you a much more refined understanding of liquidity and market movement. So now let me explain the relationship between ERL and IRL using this graphic. First of all, in the graphic you can see that we've got this level here, and this level is the drawn liquidity. That means price will be inherently and naturally inclined to move towards this level. In this case, our directional bias will be bullish because the TR liquidity is higher. Let's say price reacted off of a discount key level somewhere around here. Because of that reaction to the discount key level, there was an expansion move higher. With this expansion, you can see that price took out external range liquidity, ERL, to the left. We know that after price takes out an external range liquidity, the next thing it usually does is fill internal range liquidity, IRL. You can see that after it took out the ERL, it then moved down to complete the next step of its cycle, which is to fill the IRL. After IRL, price had another expansion higher. With that expansion, it took out ERL again, in the form of breaking this high, and continued in the same fashion, cycling higher towards the drawn liquidity. After taking out ERL, price came down once more to fill IRL, or internal range inefficiency. After that, the next thing you can expect, or the next thing price will gravitate towards, is ERL, or external range liquidity again. From this graphic, although it is a cherry-picked example and won't be this clear on live charts, you can clearly understand the relationship between ERL and IRL. You can see that price moved from ERL to IRL to ERL to IRL, and it continued in this fashion until it reached the drawn liquidity. Once it reaches that drawn liquidity, the dynamic changes. In the next slides, I'm going to explain what happens after a high time frame key level or the drawn liquidity is reached, how that dynamic changes, and how you can adjust to it. Now let's dissect this price action based on internal range liquidity and external range liquidity. First of all, we're going to assume that the drawn liquidity is lower, and that around this top area, we reacted to a premium key level. These are the two main assumptions or prerequisites for this particular price action. So with the drawn liquidity being lower, this means that the directional bias will be bearish, and will naturally expect bearish price action. You can see that after reacting to that premium key level, price expanded lower. With this expansion, or move, price took out external range liquidity, ERL. After taking out ERL, price retraced back higher towards a fair value gap and tested that, which meant that price then filled internal range liquidity, IRL. After filling IRL, price had another move lower, taking out more external range liquidity. Following that, price retraced higher again and tested IRL in the form of an order block. Again, once IRL is filled or tested, the next typical move from price is to expand lower and take out more ERL. In this case, we saw ERL form again, and price dropped down to take out that liquidity. After that, it moved back up to first fill a fair value gap and test an order block. This meant that price had once again filled internal liquidity. After doing so, Price then moved lower again to take out external liquidity, this time targeting the low here. You can see how price continues to move in this repeating fashion, taking out external liquidity, then filling internal liquidity, and repeating the cycle. This is how price moves, from ERL to IRL, then back to ERL, and again to IRL, and so on. Obviously, the main prerequisite for making this approach tangible is that you must first identify the draw on liquidity. Without knowing that, you won't be able to correctly determine the relevant ERLs. Now that we've broken down the types of liquidity, let's talk about one of the most important concepts in this entire framework: draw liquidity. Honestly, this is the core of your analysis and your trade ideas. Every single trade you take and every idea you form should be rooted in the concept of draw liquidity. If your trade idea or your analysis isn't aligned with draw liquidity, chances are it's going to fail, or at best, be inconsistent. So what exactly is draw liquidity, and why is it so important? Basically, your draw liquidity is the most probable key level that price is reaching for, on whatever time frame you're analyzing. It's the most likely level that price is being drawn towards, acting like a magnet for price action. Whatever direction price is moving toward that draw, that becomes your directional bias. This draw liquidity can take many forms. It could be a high or a low, meaning external range liquidity, or it could be a fair value gap, an order block, or any other key level that fits within the internal range liquidity framework. The reason why identifying your draw liquidity is so crucial is because, first of all, it becomes one of your strongest filters. What I mean by that is, once you know where price is most likely headed, you can automatically filter out half of the noise. Let's say your draw liquidity is higher, or to the upside. That instantly invalidates all the bearish trade ideas for you. You are no longer looking to short. You don't care about bearish signals or bearish setups because you know price is most likely being drawn upward, and you wouldn't want to trade against that direction. And vice versa, if your draw liquidity is lower, you immediately disregard all the bullish or long setups. So instead of trying to trade every pattern or model in both directions, you develop a much more structured approach. You're no longer randomly chasing trades because you're focused on one clear objective: trading in the direction of the draw liquidity. The second reason this concept is so powerful is that it helps you stay aligned with the market. When you know where price is most likely headed, you stop taking counter setups that go against the trend or order flow. You're no longer second-guessing whether a pattern is valid or not, because you already have a macro-level direction in mind. You know you're only going to be trading in that direction. This helps you avoid ending up on the wrong side of the market, trying to force trades in a direction price simply isn't interested in going. That's a mistake most traders make. They chase trades in the opposite direction of where the market is actually trying to go. Because of this, those traders almost always fail. Finally, draw liquidity helps you understand what the market actually wants to do, not what you want it to do. Because of that, you stop forcing invalid setups. You stop holding on to biased ideas that no longer make sense, and you start adapting to what the market is actually showing you. That shift in mindset is huge. Now, your job isn't to be right. Your job is to position yourself in the direction the market is already planning to go. That's why the concept of draw liquidity is so important. It simplifies your entire process, aligns you with the market, keeps you out of bad trades, and helps you focus on the most probable scenarios, not the most hopeful ones. This is a concept you'll come back to over and over again, because it's the foundation of a structured, high-probability trading approach. Now let's talk about the types of drawn liquidity and what each one represents. Just to clarify, this is different from the types of liquidity we talked about earlier. That was about liquidity itself and IRL. Here, we're specifically focusing on the concept of drawn liquidity, which is related but separate. To properly understand the different types of drawn liquidity, you need to bring in the idea of time frame alignment. This is super important because it helps you recognize how different drawn liquidity forms across various time frames and how they relate to the underlying liquidity types, like ERL and IRL. There are two common ways to align your time frames. The first is using consecutive time frames. For example, if you're using the weekly time frame, your lower time frame would be the daily. If you're using the daily, you drop down to the 4-hour as your lower time frame, and so on. This is called consecutive time frame alignment because we're using time frames in a sequence. The second method is the classic ICT alignment. For example, if you're using the daily as your higher time frame, your lower time frame would be the 1-hour. If your higher time frame is the 4-hour, then your lower time frame would be the 15-minute. This is what we call ICT time frame alignment. Both approaches to time frame alignment are valid, and you can use either one depending on the context you're working with. With that in mind, we can break down drawn liquidity into two types: long-term drawn liquidity and short-term drawn liquidity. Long-term draw refers to the high time frame, ERL or IRL, whereas short-term draw refers to the lower time frame, ERL and IRL. Long-term drawn liquidity is the macro target that price is reaching for or walking toward over time. Short-term drawn liquidity, on the other hand, is the lower time frame, ERL or IRL, that price may seek to hit or reach before continuing toward the higher time frame objective. The key point here is that price doesn't usually go straight toward the long-term drawn liquidity when there is short-term drawn liquidity already present. When both short-term and long-term drawn liquidity exist, price typically gets pulled toward the short-term draw first. Once it clears that level, taking out or filling the short-term liquidity, only then does it begin to move toward the long-term target. For example, you may have experienced a situation where you know drawn liquidity is in a certain direction, so you start posting trades in that direction. But then price pulls back, reverses, and takes you out before moving in the direction you originally anticipated. That often leads to losses, frustration, and second-guessing, even though your original bias wasn't wrong. To cope with or solve that problem, you need to differentiate between the two types of drawn liquidity. You need to understand that both short-term and long-term draws can exist at the same time. Your objective, first of all, should be to target the short-term draw, because that's what price does. It first targets the short-term drawn liquidity. Once that's taken out, it starts moving toward the long-term drawn liquidity. Even if your original bias is correct, it could be incomplete because you're ignoring, or unaware of, the short-term liquidity present first. When you recognize that, you won't second-guess yourself or feel frustrated because you'll understand exactly what's going on. This is really important because many traders make this mistake. It's like you're right about the destination but wrong about the path that price would take to get there. So you need to figure out not only where price is going, but also how it's going to get there. In what kind of fashion or rhythm price will move toward the long-term drawn liquidity. Understanding this relationship between short-term and long-term drawn liquidity is extremely important. It allows for better decision-making, cleaner entries, and more accurate expectations and anticipations for price. This awareness will keep you from jumping in too early or forcing trades in the wrong sequence. Instead, you'll wait for the short-term draw to be taken out first, and then align yourself with the higher time frame direction, the long-term drawn liquidity, once price is ready. Okay, so now that we've gone over everything about liquidity, drawn liquidity, and their types, let's quickly cover one final but very important mini-topic: dynamic changes. The key idea here is that you need to be able to recognize when the liquidity cycle is flowing normally and when it shifts. The market doesn't always stay in one mode. It shifts from one mode to another over time. The way it usually works is that price moves in a continuous cycle from ERL to IRL, then IRL to ERL, back and forth. That's the default rhythm. Price sweeps external liquidity, then returns to fill internal inefficiencies, and so on. But this cycle only continues until price reaches a major higher time frame draw on liquidity. Once that happens, we often see a shift in the delivery dynamic. Price then begins to move from ERL to ERL directly, temporarily skipping the IRL phase. This is known as a CSD, or a change in the state of delivery. What this means is that after price hits a significant long-term draw on liquidity, the internal liquidity cycle pauses. Price enters a more aggressive phase, running from one ERL to another ERL without coming back to fill internal imbalances in between. This is the CSD phase. Once the change in the state of delivery plays out, price eventually settles back into its normal flow and resumes the ERL to IRL cycle again. That continues until another major liquidity draw triggers the next shift. Being aware of this change is extremely important. If you're expecting price to come back and fill gaps or test blocks while it's actually in a post-CSD phase, you'll keep waiting for retracements that never come. That can leave you confused, thinking something's broken, when really the market has just shifted delivery modes. But once you understand this, everything clicks. You'll be able to immediately recognize what phase the market is in and adjust your expectations and anticipations accordingly. Understanding dynamic changes isn't just helpful, it's necessary if you want to stay in sync with the market at all times. The market doesn't stay in one mode forever. Usually it moves in a cycle from ERL to IRL and back again, continuing until a major liquidity target or key level is hit. Once that happens, price immediately jumps from one ERL to another ERL, and the dynamic changes, so you need to be able to recognize that shift when it happens. Now let's walk through this chart example. First of all, you can see that once price took out this exact high, it kicked off a bearish order flow. The first thing to note here is that we had a CSD, a change in the state of delivery, and that CSD caused a shift in structure. After that shift happened, we started moving in a classic cycle from ERL to IRL, and then from IRL to ERL. Here is exactly what happened. First, price took out this ERL. It took out this low. After taking out this external range liquidity, it then retraced and filled this IRL before moving lower again. Then, after taking out this ERL again, this external range liquidity, we saw another retracement. This pullback filled internal range inefficiency and internal range liquidity before price moved lower once more. Once that was filled, price tested this fair value gap, this IRL, after taking out the ERL. Only then did we begin moving lower and took out another ERL in the form of these lows. Again, we retraced and filled this IRL, continuing to move lower in that same pattern, taking out ERL, then filling IRL and repeating. This continued until price moved lower and hit a discount key level. After testing this discount key level, the dynamic changed. We no longer saw price moving in the ERL to IRL cycle. Instead, you can see that it jumped straight from one ERL to another ERL. It took out a low and then immediately took out another high, instead of filling IRL and continuing lower. The reason for that was the test of the discount key level. As mentioned earlier, once price reaches a high time frame objective or a high time frame draw on liquidity, the dynamic changes. At that point, we go from one ERL to another ERL. After this ERL, we had an expansion. That expansion took out external range liquidity and closed above this high, confirming another shift in structure, meaning we had another CSD. Because of that, we started a new bullish order flow. Price then began moving in a new cycle of ERL to IRL and back to ERL. This cycle continues until price reaches another higher time frame liquidity objective. After taking out this ERL, price came down, filled inefficiency and internal range liquidity, specifically testing this order block here. Once it filled that internal range liquidity, it expanded again and took out external liquidity in the form of this high and the following highs. At this point, price failed to take out a specific high, but on GU, there was an SMT divergence, meaning GU took out that high, the ERL, but EU failed to do so. After that divergence, price came down again, filled IRL after taking out another ERL, and then continued higher. Once we tested this order block and filled this IRL, the internal range equity, the next probable move was another ERL expansion, aiming to take out more external range liquidity. You can see that with this move higher, price took out another external range liquidity. The important thing to understand here is that once price takes out an ERL, the next probable move is not an immediate continuation higher. That's a common mistake. The more likely scenario is for price to retrace and fill an IRL or internal liquidity before doing anything further. To figure out exactly which IRL price might come back to fill, you can use a combination of dealing ranges and open high-low close levels. I'll cover that process in detail in a separate chapter, but just know that's typically how you identify the IRL target. In this case, price has taken out an ERL, so the next likely move is to fill this IRL. It's not likely to go higher immediately, even though we're in a bullish structure. Instead, a move lower is expected first. This is where many people go wrong. If you were too focused on your higher time frame bullish bias and forced bullish trade ideas right after the ERL was taken, you likely would have ended up on the wrong side. Not because your bias was wrong, it was technically correct, and the order flow was bullish, but because you ignored the ERL to IRL cycle. So even though your bias is bullish, you should still expect price to retrace and show bearish price action in the short term to fill this IRL. That's why understanding this cycle is so important. It helps you avoid entering too early. Since we're on the daily time frame in this example, the IRL that we're expecting price to fill becomes the long-term draw on liquidity for lower time frames. That's the target we'd expect price to reach before it resumes or continues moving higher. From here, we use consecutive time frame alignment. I'll now drop down to the 4-hour time frame to identify the short-term draw on liquidity and the short-term ERL and IRL. You could also use ICT alignment, such as the 1 hour under the daily, and that would work as well. Both approaches are valid. It just depends on the context you're working with. In this particular case, the consecutive time frame alignment made more sense because I'm analyzing this price action to determine my drawn liquidity. I'm not analyzing it for execution or entry purposes. If I were looking to take trades, then I'd probably use the ICT alignment instead. But since I'm just working to determine exactly where the draw on liquidity is, I've used the consecutive time frame alignment because it made the most sense here. Now, looking at the 4-hour time frame, what you can see is that our long-term draw on liquidity for this particular time frame is this daily IRL. We took out this daily ERL, which was our initial long-term draw, and now the next likely thing price is going to do is retrace lower or reverse on this time frame toward that daily IRL. That becomes our long-term draw on liquidity. Zooming in, you can see right here that we had an SMT divergence with GU. EU took out this high and GU failed to do so, which means we had non-symmetry in price. This exact SMT divergence confirmed our bias that price is now going to retrace back to fill this IRL first before it continues moving higher or does anything further. So from here, our expectation is for price to continue lower. Now let's see what price does. What you can see here is that price had an expansion lower. With this particular expansion, we took out external range liquidity, this short-term ERL. Now that ERL has been taken out, the next most likely and probable scenario, or the most profitable move for price, is to retrace back higher and fill this short-term IRL. This short-term internal range appears in the form of this fair value gap before continuing lower toward the long-term draw. So at this point, our short-term draw is first of all this fair value gap. Instead of forcing bearish trades immediately from here, you would be expecting price to first fill this FVG before continuing lower. What you can also see right here is that price had an SMT divergence with DXY. If I show you the DXY chart, you would see that DXY filled this fair value gap and also filled this internal range liquidity. That means the upper wick took out this external range equity. DXY then retraced lower and filled this internal liquidity, just as we expected or just as I anticipated. Now on EUR/USD, it failed to fill this internal range liquidity or this fair value gap. But it did that because of the SMT divergence, so technically our buy was still correct. EUR per USD might not have filled this FVG, but the only reason it didn't was due to the lack of symmetry, or more specifically, because of the SMT divergence. So again, you could say our initial price idea was right. EUR per USD retraced higher to take out internal range liquidity, while DXY filled the corresponding fair value gap. Once that was complete and the SMT divergence was in place, only then did it begin to move lower and start this expansion downward. So now, as you can see, with this expansion leg lower, we took out another ERL. We took out another external range liquidity. From here, our expectation would now be for price to fill this IRL, or internal range liquidity, before it continues moving lower. It would continue moving lower toward this long-term draw. What you can see here is that after we filled this value gap, after we filled this internal range liquidity and had this SMT divergence, this key level SMT divergence with DXY, we then continued moving lower again toward the long-term draw. What happened here is that instead of continuing lower immediately toward the long-term draw, it first filled the short-term draw, which is this internal range liquidity. Then it continued moving lower. Along with that, we also had this key level SMT divergence. EU failed to test this FVG, but on DXY, you can see that we did test the FEG. That means we had non-symmetry, and we had SMT divergence, which confirmed that price could now continue moving lower to take out another external range liquidity. In this case, our next external range liquidity would be this low right here. Now, looking at this another example right here, you can see that on the weekly time frame, gold took out this ERL, this external range liquidity. The most likely scenario for price now is to retrace back lower to fill IRL, internal range liquidity, before it starts moving higher, continues higher, or does anything further. What you can see right here is that we've got this FVG, this internal liquidity, in the form of a weekly fair value gap. Instead of price continuing higher immediately from here, it first retraced back lower to fill this internal range liquidity. This is what we call the cycle of ERL and IRL. This is exactly how you can improve your decision-making process, by understanding and keeping in mind that price doesn't move in a straight line. It moves in a cycle, from ERL to IRL, and then from IRL to ERL.